The lights still function. Security cameras sweep empty corridors on programmed intervals. Climate control systems cycle air through spaces no one occupies. Landscaping crews arrive on schedule, trimming hedges around a building that generates no revenue. The elevators pass inspection. The fire suppression system receives quarterly testing. The parking structure remains structurally sound. Nothing is broken. Everything works exactly as designed. The problem is not decay. The problem is purpose. The facility operates at full capacity while serving no function that justifies its cost. Maintenance continues because stopping would destroy value faster than continuing. But continuation only delays the inevitable recognition that operational expenses will never align with achievable returns. If a project requires constant investment just to stand still, was it ever sustainable, or only tolerated while money stayed? When construction ended, the risk didn't disappear. It changed form. The final inspection report carried no deficiencies. Contractors submitted closeout documentation. The certificate of occupancy was issued without conditions. Punch list items were addressed. Systems came online according to schedule. The project that had existed as drawings, permits, and progress reports for years became a physical structure occupying space and demanding resources. Completion is often treated as resolution. Financing transitions from construction to permanent debt. Attention shifts from building to operating. The narrative changes from what will be created to what has been achieved. But completion in construction terms means only that assembly is finished. It says nothing about whether the asset will function as projected or generate returns sufficient to justify its existence. This project completed on budget and on time. By conventional metrics, delivery was successful. No cost overruns, no schedule delays, no quality failures that would require remediation. The building performed as specified, yet from the moment the final systems went live, the economic fundamentals were strained. Operating expenses began accruing immediately. Property taxes came due, insurance premiums were calculated on completed value, utilities activated, staffing commenced. The monthly burn rate that construction financing had anticipated became operational reality. Revenue projections that had supported financing decisions now faced market testing. Would demand materialize at projected levels? Would pricing hold where models assumed? Would operating efficiency match the optimized assumptions built into financial plans? The answers emerged slowly, but they emerged consistently in one direction. Actual performance lagged projections, not catastrophically, not in ways that triggered immediate crisis, but persistently, across multiple metrics, reality underperformed expectation. Completion had resolved construction risk. It had not resolved market risk, operational risk, or the fundamental question of whether this asset could sustain itself in the economic environment that existed rather than the one that had been projected. The building stood finished. The problem was just beginning. This wasn't funded by belief. It was funded by projections. The capital structure was conventional for projects of this scale. Senior debt from institutional lenders covered approximately 60% of total cost. The loan carried standard terms, floating rate tied to benchmark, debt service coverage requirements, periodic reporting covenants. The lenders were not gambling. They had underwritten to conservative projections and required substantial equity cushion below their position. Equity came from multiple sources. The developer contributed capital, though less than external observers might assume. Most development equity in projects this size comes from funds and high net worth individuals seeking returns that justify the risk premium above debt investments. These were not amateurs. They had access to the financial models, the market studies, the engineering reports. They understood the variables and had sized their exposure accordingly. The investment thesis was straightforward. The project would serve a market segment with demonstrated demand. Comparable facilities in similar locations generated cash flows that, when adjusted for this project's specific characteristics, supported the projected returns. Construction risk was mitigated through fixed-price contracts and performance bonds. Operating risk was addressed through pre-committed anchor users and pricing studies. On paper, the returns justified the risk. The equity investors were not chasing moonshots. They were deploying capital into an asset class with historical performance data, in a market with established dynamics, using a business model with proven precedents. What made this possible was not optimism. It was mathematics. Financial models projected cash flows. Those cash flows were discounted to present value using rates that reflected the perceived risk. The resulting valuations exceeded the required investment by margins sufficient to interest institutional capital. The lenders wanted their debt serviced. The equity investors wanted returns that compensated for illiquidity and risk. The developer wanted a successful project that would generate fees and establish credentials for future work. Everyone's interests appeared aligned around a single outcome: operational success that would generate cash flow and validate the decision to deploy hundreds of millions of dollars. The capital was serious. The underwriting was professional. The assumptions were derived from market data and industry benchmarks, yet every assumption rested on one foundational premise: that the future would resemble the past closely enough for historical patterns to predict performance. That premise, rarely examined and almost never questioned during periods of confidence, would prove insufficient. Every spreadsheet assumed one thing would never change. The financial models that supported investment decisions were detailed and sophisticated. They projected revenues by category, estimated operating expenses line by line, calculated debt service obligations, and modeled cash flow across decades. Sensitivity analyses tested how performance would respond to variations in key assumptions. Risk factors were identified and quantified. Buried within these models, so fundamental that it rarely appeared as an explicit assumption, was the premise that market conditions supporting initial projections would persist. Not forever, not without variation, but persistently enough that the project could stabilize, establish operating patterns, build occupancy or utilization, and reach the performance levels that justified the capital deployed. This assumption took different forms depending on the project type. For projects dependent on visitation, the assumption was that population demographics, transportation patterns, and consumer preferences would maintain demand at levels sufficient to generate target revenues. For projects dependent on anchor tenants, the assumption was that those commitments would hold and that secondary space would lease at projected rates. The models acknowledged short-term volatility. First-year performance was expected to fall below stabilization. Ramp periods were built into projections. But the underlying assumption remained. Given reasonable time, the project would reach performance levels that generated positive cash flow and supported the debt. What the models did not adequately address was the possibility that foundational market dynamics might shift permanently, that the demand thesis supporting the project might erode not temporarily, but structurally, that external factors, economic, demographic, technological, competitive, might change the equation in ways that made original projections unattainable regardless of operational execution. This was not oversight. Financial modeling requires assumptions about the future. Those assumptions must be drawn from observable data, which means historical patterns and current trends. Models that assumed fundamental discontinuity with the past would produce results so uncertain as to be meaningless. The methodology required assuming some degree of continuity. The problem was not the modeling technique. The problem was that reality did not honor the assumption. The market conditions that had supported the investment thesis began shifting earlier and more profoundly than anyone had projected. What had been assumed to be stable revealed itself as contingent. What had been treated as given turned out to be variable. By the time this became undeniable, capital was deployed, construction was complete, and the project was operational. The assumption of sustainability had been tested by reality. It had failed. Stopping operations would have destroyed value instantly. The economics of stopping were worse than the economics of continuing. This created a situation where losses had to be sustained, not because there was hope of reversal, but because cessation would crystallize losses that ongoing operation merely deferred. For projects with physical presence, closure triggers immediate value destruction. Unoccupied buildings deteriorate faster than occupied ones. Climate control systems that cycle off allow moisture accumulation. Security becomes more difficult and more expensive without daily human presence. Vandalism and theft become material risks. The longer a facility sits dark, the greater the capital required to bring it back to operational condition. Insurance rates increase for vacant properties. Lenders view cessation as distress and may accelerate debt or demand additional reserves. Municipalities may increase scrutiny or seek code enforcement actions. Employees with institutional knowledge depart, making eventual restart more difficult. Beyond physical degradation, closure destroys going concern value. An operational facility, even one losing money, retains value as a functioning enterprise. Buyers evaluating acquisition can observe performance, assess systems, and model improvements. A shuttered facility is a turnaround project requiring capital deployment before any return becomes possible. For projects with debt service obligations, stopping operations does not stop debt service. Interest accrues whether or not revenue is generated. Stopping operations means paying debt service entirely from reserves or additional capital injections, with no offsetting cash flow to reduce the burn rate. The decision to continue operating was not irrational. It was defensive. Every month of operation consumed cash. But stopping would have consumed more cash faster and reduced the asset's residual value. The choice was between managed decline and immediate collapse. This is how projects enter operational limbo. They generate insufficient cash flow to justify their existence, but sufficient cash flow to make continuation less damaging than cessation. They become assets that cannot be profitably operated, but cannot be easily disposed of. They continue because stopping is worse, not because continuing works. Operating expenses at this project included staffing, utilities, maintenance, insurance, property taxes, and debt service. The monthly total exceeded $2 million, revenue covered perhaps 60%. The deficit came from reserves, equity injections, or deferred payments to vendors and contractors. Management reduced staffing where possible. Maintenance shifted from preventive to reactive. Marketing budgets were cut. But core systems had to function. Climate control could not be fully terminated without risking infrastructure damage. Security could not be eliminated without inviting liability. A skeleton crew capable of maintaining basic operations represented an irreducible minimum. The project kept running not because anyone believed performance would improve sufficiently to solve the problem. It kept running because the alternative was admitting immediately that hundreds of millions of dollars had been committed to an asset that could not sustain itself. As long as operations continued, the possibility of stabilization, however unlikely, remained technically alive. This was the arithmetic of operational loss aversion. The project had to keep running until someone with authority to stop it accepted the consequences of doing so. The size that justified the investment also removed flexibility. Large-scale projects achieve certain efficiencies. They can support specialized staff. They can negotiate better rates on supplies and services. They can amortize fixed costs across greater output. These advantages are real and often necessary to make projects financially viable. But scale also creates inflexibility. A smaller project can adjust more readily to changing conditions. It can reduce operations without triggering systemic failure. It can pivot to alternative uses without massive reconfiguration. It can be sold to a wider pool of potential buyers. This project was designed at a scale that required specific performance levels to work. The facility was sized for certain capacity. Staffing ratios assumed certain utilization. Debt service was structured around certain revenue projections. The entire system was optimized for a particular operational model. When performance fell short of projections, the system could not simply scale down proportionally. A facility designed for one operational model cannot easily operate at 60% of that model without fundamental restructuring. The fixed costs do not decline proportionally with revenue. The building still occupies the same footprint. Property taxes do not adjust to utilization rates. Debt service does not flex with performance. Investors found themselves locked into a scale that had been necessary to justify the original investment, but that now amplified losses. They could not simply operate a smaller version of the project. The asset they owned was the asset they owned. Reducing scope would require capital expenditure for reconfiguration and would not eliminate proportional costs. Scale also limited exit options. The pool of potential buyers for assets of this size and specificity is narrow. Institutions capable of acquiring projects at this scale are sophisticated. They conduct extensive due diligence. A project with visible performance problems attracts attention from only the most opportunistic buyers who discount for risk and uncertainty. Selling at a meaningful discount would crystallize losses immediately and publicly. It would force investors to recognize that capital had been permanently impaired. It would likely trigger consequences in other parts of investment portfolios if markdowns were required. The decision to hold became less about believing in recovery and more about avoiding the consequences of exit. As long as the project remained in the portfolio, losses could be characterized as temporary, operational challenges rather than permanent capital impairment. Exit would force recognition that the scale that had made the project possible had also made it a trap. This is a common dynamic in large-scale development. The size required to achieve viability also creates rigidity that makes adaptation to unfavorable conditions extremely difficult. Investors become holders not by choice, but because all alternatives are worse. There was no version of this project that was cheap. Cost reduction in operational distress follows a predictable sequence. Discretionary spending stops first. Marketing, events, non-essential maintenance, these disappear quickly. Next comes staffing reductions. Positions are eliminated. Remaining employees absorb additional duties. Hours are cut. Finally, management attacks variable costs wherever possible, renegotiating contracts, switching to lower-cost suppliers, deferring anything not immediately critical. This project went through all those phases. Budgets were slashed. Staff was reduced by more than 30%. Vendor contracts were renegotiated. Every expense that could be eliminated was eliminated. What remained was the irreducible core, costs that could not be removed without ceasing operations entirely. Property taxes based on assessed value continued regardless of financial performance. Insurance premiums reflected the asset's replacement value and risk profile, not its operational success. Debt service obligations were contractual and non-negotiable. Utilities for a facility this size had minimum costs even with aggressive conservation. Structural maintenance could be deferred, but not eliminated. A building this size generates constant maintenance demands. Roofs develop leaks. HVAC systems require service. Elevators need inspection. Fire suppression systems must remain operational to maintain insurance and code compliance. Plumbing, electrical, and structural systems all demand ongoing attention. Security represented another non-discretionary category. An asset worth hundreds of millions cannot sit unprotected. Liability concerns required minimum security presence. Lenders often mandated security standards as loan conditions. Staffing could be reduced but not eliminated. Someone had to be present to manage operations, coordinate vendors, respond to issues, and maintain institutional knowledge. Below certain staffing levels, the remaining employees could not cover essential functions. Even aggressive cost management left monthly operating expenses well over $1.5 million. Revenue in weak months barely exceeded $1 million. The deficit was structural, not the result of operational inefficiency or poor management. The project cost what it cost to operate. No amount of economizing could bridge the gap between expenses and achievable revenue. This dynamic is common in projects that fail to perform as projected. Initial budgets assume revenues sufficient to cover well-managed operations. When revenues fall short, cost reductions can narrow the gap but cannot close it. A deficit remains because the asset itself requires certain minimum expenditures to remain viable. Investors faced a choice with no good options. Continue funding deficits and watch capital drain away. Stop funding and watch the asset deteriorate while debt service continues. Sell and crystallize losses. Each alternative was unattractive. The path of least immediate pain was to continue, hoping that market conditions might improve enough to narrow the gap even if profitability remained distant. The costs that couldn't be reduced defined the problem. This project could not be downsized to match available revenue. It was what it was, and what it was required more money than it could generate. Money stopped building value and started buying time. The first months after opening were about establishing operations. Staff learned their roles. Systems were refined. Initial performance metrics were analyzed. Everyone understood that ramp periods were normal. The focus was on reaching stabilization. By the end of year one, stabilization had not occurred. Revenues were running 20% below projection. Operating expenses were only marginally below budget despite aggressive cost management. The cash flow gap was wider than modeled. Year two showed no material improvement. Adjustments were made to pricing, marketing, and operations. Some initiatives showed modest positive results. Others failed. The overall trajectory remained concerning. Investors began receiving requests for additional equity injections to cover deficits. The requests came with operational plans. New revenue initiatives would be tested. Further cost reductions would be implemented. Market conditions showed signs of potential improvement. Management remained confident that with additional time and capital, performance would reach acceptable levels. Investors approved the injections. The amounts were significant but not catastrophic. Everyone understood that projects sometimes required additional support during ramp periods. The alternative, allowing the project to fail for lack of bridge capital, would guarantee loss of everything invested to date. Year 3 brought the same pattern. Performance remained below projections. Further capital injections were requested. Each request came with updated plans showing how this injection would be the last. Each time, investors calculated that the incremental capital required was less than the loss that would result from stopping. This is when cash flow became defensive. The money was no longer building value toward stabilization. It was buying time, deferring the moment when someone would have to acknowledge that the project could not reach self-sustaining. Operations. Operating expenses during this period stabilized near $28 million annually. Staffing had been reduced to 85 full-time equivalents. Energy costs alone exceeded $400,000 monthly. Insurance was $150,000 monthly. Property taxes were $200,000 monthly. Debt service was $800,000 monthly. Maintenance, supplies, professional services, and miscellaneous expenses filled the remainder. Revenue averaged $18 million annually. Good months reached $1.8 million. Weak months fell to $1.2 million. Seasonal patterns were predictable but did not help. The annual deficit approached $10 million. Each quarter, management presented results and requested capital. Each quarter, investors approved enough funding to reach the next quarter. No one wanted to be the investor who stopped funding and triggered collapse. No one wanted to initiate the conversation about whether continuing made sense. The cash flow had become a countdown. Investors were not deploying capital to capture returns. They were deploying capital to delay recognition that returns would never materialize. Money was buying time for a situation where time had no solution. This dynamic can persist longer than outside observers expect. As long as investors can fund deficits without being forced to mark down other holdings, as long as the incremental capital required remains manageable, and as long as no single investor wants to force a crisis, the process continues. Eventually, something changes. Investor capacity to fund deficits reaches limits. Lender patience expires. Market conditions shift in ways that make continuation obviously futile. But until that moment, defensive cash flow can sustain projects that everyone privately understands are not sustainable. Walking away wasn't emotional, it was calculated. Investor behavior during project distress often appears from the outside as either stubborn optimism or irrational commitment to sunk costs. The reality is more methodical. Sophisticated investors understand that panic crystallizes losses. A distressed sale under pressure produces the worst possible outcome. Buyers know the seller is motivated. Bids come in well below intrinsic value. The transaction confirms publicly that the investment failed, which can have implications for other holdings and future fundraising. The alternative is patience. Continue funding at levels sufficient to maintain operations. Test adjustments to the operational model. Wait for market conditions to improve. Explore recapitalization alternatives that might bring in new capital at terms that protect existing investment. This approach only works if two conditions hold. First, investors must have capital available to fund ongoing deficits without distress in other parts of their portfolios. Second, the rate of capital consumption must be manageable relative to the total investment at risk. For the first 3 years of operations, both conditions held at this project. The monthly deficit was substantial but predictable. Investors had committed to the project knowing that additional capital might be required. The amounts requested fell within contemplated ranges. What investors were calculating was not whether the project would succeed as originally projected. That outcome was no longer plausible. They were calculating whether holding could preserve more value than exiting. A sale under distress might recover 40 cents on the dollar. Continuing to operate while exploring alternatives might preserve 60 cents. The decision to continue funding deficits was based on that arithmetic. Each dollar deployed was preserving expected recovery value by more than $1. This logic holds until it doesn't. At some point, continued operation consumes capital faster than it preserves value. At some point, market conditions become clear enough that no improvement is likely. At some point, the capital required to continue exceeds investor capacity or patience. Investors were monitoring specific thresholds: debt service coverage ratios that would trigger lender action, cash reserves that would be exhausted absent additional injections, market indicators that would signal whether demand might recover, discussions with potential recapitalization partners that might provide exit opportunities. The decision to stop funding came when analysis showed that continuing could not improve outcomes. The project had reached its operational ceiling. Further capital injections would only delay the inevitable while consuming resources that could be deployed elsewhere. The withdrawal was not panic, it was acceptance. The investors had tested whether the project could reach sustainability. The answer was no. Further funding would not change that answer. It would only increase total losses. This realization did not arrive simultaneously for all investors. Some reached the conclusion earlier, others maintained hope longer, but consensus eventually formed around a single recognition. The project as currently structured could not generate cash flows sufficient to justify continued support. The withdrawal was methodical because these were professionals making calculated decisions about capital allocation. They had given the project time, capital, and expertise. Performance had not responded. The rational choice was to stop. No announcement marked the exit, only fewer approvals. Capital withdrawal from distressed projects rarely follows dramatic pronouncements. There are no press releases declaring defeat. No meetings where investors unanimously vote to abandon the project. Instead, withdrawal happens through quiet decisions made in sequence over months. The first signal is subtle. A capital request that previously would have been approved routinely now faces questions. Why is this necessary? What alternatives were considered? Can this be deferred? The questions are reasonable on their face, but their presence indicates shifting sentiment. Next comes delay. Request that would have been approved in days now takes weeks. Investors need more information. They want additional analysis. They are discussing internally. The capital eventually arrives, but the process has changed. Urgency has been replaced by reluctance. Then comes partial approval. Management requests $2 million to cover a quarterly deficit. Investors approve $1.5 million and ask for revised projections showing reduced burn rate. The message is clear without being explicit. Capital is no longer unlimited. At some point, a request is declined. Not refused, but deferred pending further review that never concludes. Management is asked to explore alternatives. Perhaps certain operations can be reduced. Perhaps a smaller capital injection would suffice. The request sits unanswered while management scrambles to find ways to operate without the capital they had expected. This process is uncomfortable for everyone. Management knows they are losing support, but cannot force investors to commit capital. Investors know the project is failing, but cannot agree on the optimal exit strategy. No one wants to be the party that triggers collapse. But no one wants to contribute more capital to an enterprise they no longer believe can succeed. At this project, the withdrawal pattern followed this script precisely. In year 3, capital requests were approved with minimal discussion. In year 4, questions increased. Approvals came slower. By mid-year 4, requests were being approved at reduced levels. By late year 4, management was operating on starvation funding, able to maintain basic operations but unable to invest in improvements or address deferred maintenance. The word unsustainable entered conversations, not as accusation, but as observation. The project was consuming capital faster than any plausible operational improvement could offset. Everyone understood the arithmetic. The discussion shifted from how to fix the project to how to exit with minimal, additional loss. Investors were no longer debating whether the project could succeed. They were debating whether to sell immediately at a significant loss, attempt to recapitalize with new investors, or hand the keys to lenders and walk away from their equity. Management continued operating as though stabilization remained possible. They presented plans, they identified opportunities, they requested capital for initiatives they claimed would change the trajectory. But the money stopped flowing. The decision to stop believing was not made in a moment. It emerged gradually as investors individually reached the same conclusion. Additional capital would not solve the fundamental problem. The project had been tested by market conditions. It had failed the test. Continuing to fund operations was not patience, it was denial. No meeting was held to declare the project unsustainable. The recognition simply became consensus, and once consensus formed, capital approvals stopped. Management was left to operate a project that could not operate without capital, on a budget that could not sustain operations. The project didn't need growth, it needed endurance. Many failing projects collapse because they cannot scale fast enough. They burn capital during growth phases and fail before reaching sustainable unit economics. Market dynamics shift before they establish competitive positions. Execution stumbles during critical scaling windows. This project faced a different problem. It did not need to scale, it needed to maintain operations at current levels while generating cash flow sufficient to cover expenses. The requirement was not growth, it was endurance. The distinction matters. Growth requires investment, risk-taking, and tolerance for losses during expansion. Endurance requires only that current operations cover their own costs. The bar for endurance is lower. Achieving it should be simpler. This project could not achieve it. Operating at current scale, with expenses reduced to defensible minimums, revenue fell short by millions annually. The gap was not temporary volatility. It was structural insufficiency. Management had tested multiple approaches to closing the gap. Pricing adjustments to increase revenue per transaction, marketing initiatives to increase transaction volume, operational changes to reduce cost per customer served, partnerships that might bring in supplemental revenue streams. Some initiatives produced modest improvements. Others failed outright. None moved the needle sufficiently to suggest that the gap could be closed through operational adjustment. The problem was not poor management or inefficient operations. The problem was that the project as conceived required market conditions that did not exist and showed no signs of emerging. Sustainability did not require the project to generate returns that justified the capital invested. That threshold was far higher. Sustainability required only that operations cover their costs, generate enough cash flow to pay debt service, cover expenses, and maintain the asset. Return of capital could wait. Return on capital was not expected. Simply reaching cash flow break-even would have been an acceptable outcome. The project could not reach that low bar. After years of operation, multiple management changes, aggressive cost reduction, and various revenue enhancement initiatives, the fundamental equation remained unchanged. Expenses exceeded revenue by margins that could not be closed without changing either the expense structure or the revenue model in ways that were not operationally feasible. This is what made the project unsustainable. Not that it failed to generate the returns investors had underwritten, not that it struggled during ramp-up, but that after sufficient time to establish operational patterns, it demonstrably could not cover its own costs. For investors, this recognition was terminal. A project that cannot sustain itself will never return capital. It will only consume capital until investors stop funding it or lenders foreclose. There is no recovery scenario. There is only managed decline toward inevitable disposition at a loss. The breaking point was not a specific event. It was the accumulation of evidence across multiple operating periods that the gap between revenue and expenses was permanent. Market conditions were not temporarily unfavorable. They were structurally insufficient to support operations at required scale. Once investors accepted this, continued funding became indefensible. They were not buying time for recovery. They were funding losses that would continue indefinitely. The only rational choice was to stop. Sustainability, the simple ability to persist without external support, was the threshold this project could not cross. That failure made everything else irrelevant. The project still had owners, but no advocates. Legal ownership and practical commitment are different things. On paper, the investment structure remained unchanged. Limited partners held their units. General partners retained their interests. Lenders maintained their security positions. The organizational chart looked the same as it had on day one, but the relationships had changed completely. Owners no longer advocated for the project. They attended board meetings out of obligation, not enthusiasm. They reviewed financial reports with resignation rather than optimism. They discussed the project not as an investment with upside, but as a problem to be managed. This shift is common in distressed investments. The emotional and strategic commitment that characterizes early stages disappears once performance makes success implausible. Owners remain legally bound to the asset, but psychologically disengaged from its fate. The practical consequences are significant. Without owner advocacy, projects struggle to obtain resources they need. Capital requests face skepticism. Management proposals receive minimal support. Strategic initiatives get deferred indefinitely. Decision-making becomes paralyzed. No one wants to approve spending that might accelerate losses, but no one wants to make the hard choice to exit. The organization enters stasis, maintaining current operations without conviction that doing so serves any purpose beyond delaying inevitable resolution. At this project, the transition from committed ownership to passive stewardship happened gradually over year 4 and 5. Early investor calls were substantive, focused on operations and strategy. Later calls were perfunctory, focused on cash balances and funding requirements. Investors stopped visiting the property. In early years, board meetings were held on-site quarterly, allowing investors to observe operations and speak with staff. By year 5, meetings moved to conference calls. Site visits ceased. Investors were managing from spreadsheets, not direct observation. Management continuity deteriorated. The original development team had moved to other projects. Professional operators brought in to run the facility struggled without owner support. Proposals for operational improvements were met with requests for more analysis, not approval. Talented managers left for opportunities where ownership was engaged. The project entered a peculiar state. It had owners legally responsible for its performance, but it had no one willing to invest the time, attention, and capital required to address its problems. Ownership had become custodianship, maintaining the asset while waiting for someone to decide its fate. This dynamic can persist longer than seems possible. Investors are busy with other portfolio companies. Lenders are patient as long as debt service continues. Management keeps the lights on. Everyone understands the situation is not sustainable, but no one faces immediate crisis forcing action. The project operates in limbo, owned but not led, maintained but not improved, surviving but not thriving. This is ownership without confidence, legal responsibility without strategic commitment. Once belief disappears, only math remains. In early stages, projects are driven by vision. Founders or developers articulate what the project will become, why it matters, how it will serve its market. Financial projections exist, but they support the vision rather than defining it. Decisions are made based on qualitative judgments about design, positioning, and user experience. As projects stabilize, operations become more analytical. Performance metrics guide decisions. Budgets impose discipline. Financial management replaces entrepreneurial improvisation. This is healthy evolution from startup chaos to professional operations. In distress, the pendulum swings too far. Vision disappears entirely. Spreadsheets become the only lens through which the project is viewed. Every decision reduces to whether it improves near-term cash flow. Anything that cannot be immediately quantified is dismissed. This transformation happened at this project between year 4 and 5. Early leadership had treated the project as something worth believing in, despite disappointing results. They spoke about latent market potential, operational adjustments that might unlock value, strategic positioning for eventual recovery. By year 5, that language had disappeared. Investor communications focused exclusively on numbers, monthly revenue, operating expenses, cash burn rate, months of runway remaining, debt service coverage, potential recovery values under various exit scenarios. Management responded by framing every decision in cash flow terms, not whether an initiative would improve the project's long-term competitive position, but whether it would reduce the monthly deficit by $50,000. Not whether a capital investment would enhance user experience, but whether payback would occur within 12 months. This was rational given investor sentiment. Proposals grounded in qualitative benefits had no chance of approval. Only proposals demonstrating immediate cash impact received consideration. But the shift came with costs. The project became a financial entity detached from operational reality. Decisions that made sense on spreadsheets damaged the customer experience, which further depressed revenue. Staff morale collapsed as they watched the project managed purely for cost minimization rather than customer service. Accounting for asset impairment became the primary investor concern. For entities holding the investment on balance sheets at historical cost, the question was when to recognize write-downs. As long as the project remained operational and some recovery value existed, full write-off could be deferred. But quarterly reviews required assessing whether carrying value exceeded likely recovery. These calculations involved estimates of sale proceeds under various scenarios, discounted present values of cash flows under continued operation, and assessments of lender positions and likely foreclosure timelines. The analysis was technically sophisticated and completely disconnected from the physical project operating in the real world. For tax purposes, the timing of recognizing losses mattered. Investors wanted to maximize deductions while minimizing current year income. This created incentives around timing of dispositions and restructurings that had nothing to do with optimizing project outcomes. The project had become a series of cells in spreadsheets across multiple investor portfolios. Its performance affected marks, returns, tax positions, and reporting requirements. The physical asset, the building, the staff, the customers, was an abstraction behind the numbers. This is the end stage of distressed investment. Vision dies, belief disappears. What remains is arithmetic, executed by professionals managing balance sheets and tax positions, waiting for someone to decide whether continued operation or immediate. Disposition minimizes total loss. Any new buyer would inherit the same problem. Distressed assets routinely attract opportunistic capital. Investors specialize in buying troubled projects at discounts, implementing operational improvements, and selling at profits. This model works when assets are fundamentally sound but temporarily distressed due to fixable problems like poor management, over-leveraged capital structures, or short-term market disruptions. This project did not fit that profile. The distress was not temporary or fixable. The problem was structural. Operating expenses exceeded achievable revenue under any plausible operational scenario. No amount of improved management would change that equation. No recapitalization would solve it. The market simply could not support operations at the scale the project required. Potential buyers understood this immediately. Due diligence on distressed acquisitions is thorough. Buyers examine historical performance, market studies, competitive dynamics, and operational data. They model multiple scenarios for operational improvement. They calculate break-even thresholds and compare them to achievable performance. Every analysis of this project reached the same conclusion. At its current scale and configuration, it could not generate cash flow sufficient to cover expenses. Operational improvements might reduce losses, but could not eliminate them. The asset would continue consuming capital under any ownership. For a buyer to acquire the project made sense only under specific conditions. They would need to purchase at a price reflecting minimal value, essentially land and salvageable building components. They would need plans to fundamentally reconfigure the asset for a different use, and they would need capital to execute that reconfiguration. This was not the opportunity existing owners were offering. They sought buyers who would continue current operations, ideally at prices reflecting some portion of invested capital. That was not rational from a buyer's perspective. The few expressions of interest that emerged came from parties with specific plans. The few expressions of interest that emerged came from parties with specific plans to radically repurpose the asset. They were not buying the operating business. They were buying a physical structure they intended to convert to something entirely different. Their offers reflected demolition costs, rezoning uncertainty, and extensive capital requirements. The bids were far below what existing investors could accept without recognizing catastrophic losses. Other potential buyers conducted preliminary reviews and walked away without submitting offers. The due diligence process revealed what existing investors already knew. The fundamental economics did not work. No operational expertise or fresh capital injection would change that reality. Some investors hoped that market conditions might eventually shift enough to attract serious buyers. Perhaps demand patterns would evolve. Perhaps competitive dynamics would change. Perhaps users not currently viable would become feasible. But waiting for that transformation meant continuing to fund deficits indefinitely. And any future buyer sophisticated enough to execute a successful repositioning would discount heavily for the years of additional losses accumulated during the wait. The market for distressed assets is efficient. Buyers appear quickly when genuine opportunity exists. When buyers stay away despite aggressive marketing, it signals that the asset's problems are structural rather than operational. This project had been quietly shopped to specialized investors for over a year. The absence of serious offers communicated the verdict clearly. New investors stayed away because they would inherit an unsolvable problem. The project would consume their capital just as it had consumed the original investors' capital. There was no arbitrage opportunity. There was only a choice to avoid a known value trap. The project wasn't abandoned, it was unsupported. Physical abandonment would have been obvious. Locked gates, dark windows, overgrown landscaping, equipment failures, the visible decay that marks buildings when human attention withdraws completely. This project showed none of those signs. The grounds remained maintained. Systems continued functioning. Staff reported for shifts. To a casual observer, operations appeared normal. What had changed was invisible. Capital no longer flowed to address anything beyond immediate necessities. Deferred maintenance lists grew longer. Equipment ran until it failed rather than being serviced preventively. Staff positions eliminated through attrition were not refilled. The monthly operating budget had been reduced to absolute minimums. Every expenditure required justification. Anything that could be postponed was postponed. The organization operated in permanent austerity, doing only what was required to keep the doors open. This is the distinction between abandonment and unsupported operation. Abandonment is a decision to cease. Unsupported operation is a decision to continue at the lowest sustainable level, while providing no resources for improvement or even adequate maintenance. Projects in this state deteriorate slowly, rather than collapsing immediately. The decline is gradual enough that each month looks similar to the previous month. But over quarters and years, the cumulative effect becomes substantial. Systems age without replacement. Facilities show wear without remediation. The customer experience degrades in small increments that individually seem insignificant, but collectively undermine whatever value proposition the project once offered. Investors were no longer backing the project. They were tolerating its existence while searching for exit options. Every dollar spent on operations was viewed as additional loss, not investment. Management requests for capital to address deteriorating conditions were denied, unless the consequence of not spending would be immediate operational failure. This created a downward spiral. Reduced spending led to service quality decline. Service quality decline led to further revenue deterioration. Revenue deterioration increased deficits. Increased deficits hardened investor resistance to spending. The cycle fed itself. Staff morale collapsed under these conditions. Employees understood they were maintaining a project no one believed in. They watched needed repairs go unaddressed. They received customer complaints they lacked resources to remedy. Talented employees departed for opportunities with futures. Those who remained were either unable to leave or simply running out the clock until inevitable closure. The project was maintained but no longer backed. It existed in a state between operation and failure, consuming capital without purpose, waiting for someone to accept the cost of ending what could not continue. This wasn't a mistake. It was a category. The specifics of this project are unique. The location, the design, the market dynamics, the timing, all are particular to this case. But the pattern is not unique. It repeats across different asset classes, different markets, different economic cycles. Large-scale projects get financed based on projections. Those projections assume market conditions that prove overly optimistic. Construction completes successfully. Operations commence. Performance falls short. Investors fund deficits hoping for stabilization. Stabilization does not occur. The gap between revenue and expenses proves structural rather than temporary. Investors stop funding. The project enters limbo between operation and disposition. Each case has its own narrative. Observers identify specific factors that explain the failure: poor site selection, inadequate market research, weak management, bad timing, excessive leverage, unrealistic assumptions. These explanations are accurate as far as they go, but they miss the systematic element. Projects of certain types face inherent sustainability challenges that become apparent only after capital has been committed and construction completed. The common thread is not incompetence or recklessness. It is the difficulty of projecting long-term performance for assets that require sustained market demand at specific levels to remain viable. When projections prove optimistic, the scale and fixed cost structure of these projects leaves limited room for adjustment. The pattern appears in retail developments that assumed shopping behaviors would remain stable, in hospitality projects that projected visitation rates based on historical trends, in entertainment venues that modeled attendance from comparable facilities in different markets, in mixed-use developments that depended on anchor tenants whose business models were already under pressure. The projects share structural similarities. They require significant upfront capital. They have long development timelines during which market conditions can shift. They depend on external demand rather than contracted revenues. They have high fixed costs that cannot flex with performance. They operate at scales that seemed necessary during planning, but become inflexible constraints during distress. Financial modeling for these projects follows industry standards. Developers hire reputable consultants. Lenders conduct independent underwriting. Equity investors perform due diligence. The process is professional and thorough, yet the outcomes repeat with enough frequency to suggest systematic rather than idiosyncratic failure. Part of the problem is that historical data becomes less predictive during periods of structural change. A retail project financed in 2015 used data from 2005-2014 to project performance. That decade preceded the acceleration of e-commerce adoption that would fundamentally alter physical retail economics. The projections were not dishonest. They were backward-looking in a forward-changing environment. Another element is the incentive structure around project development. Developers generate fees during construction regardless of operational outcomes. Lenders earn interest on deployed capital and often syndicate loans to spread risk. Equity investors diversify across multiple projects, knowing some will underperform. No single party bears full consequences of over-optimistic projections. This does not imply fraud or negligence. It reflects the reality that large projects require assembling capital from parties with different risk tolerances and return expectations. The system works when projections prove reasonably accurate. When they prove materially wrong, losses are distributed across the capital structure in predictable ways. The pattern repeats because the conditions that enable it remain constant. Capital seeks deployment. Projects require capital. Projections bridge the gap between present capital and uncertain futures. As long as those dynamics persist, projects will occasionally be financed based on assumptions that reality does not validate. What changes across cycles is which project types attract capital and subsequently face sustainability challenges. The specific assets shift. The underlying dynamic remains. Observers often describe these failures as isolated incidents, unique circumstances, specific mistakes. But when viewed across time and asset classes, the repetition becomes clear. These are not anomalies. They are a category of outcome embedded in how large-scale development finance operates. The question is not why this particular project failed. The question is why the system continues producing projects that follow this pattern. The answer lies in the fundamental uncertainty of projecting future demand, combined with the requirement to commit capital years before performance can be observed. That gap between commitment and validation creates systematic risk that manifests as projects that complete construction successfully but cannot sustain operations. This project was not an outlier. It was an example. The pattern will repeat because the conditions that produce it are structural to how development capital functions.